This is More Knowledge, More Wealth with your host, Gabriel Shahin. Gabriel is a certified financial planner and a registered investment advisor at Falcon Wealth Planning. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the services or securities discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. Now here's your host, Gabriel Shahin.
Good day, this is Gabriel Shahin, certified financial planner, and your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. My goal is to give you the knowledge you need to increase your wealth. Now, to the listener, you can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON. Like the bird, or visit our website at falconwealthplanning.com. That's falconwp.com for short, to get this episode or any one of our previous episodes through our Knowledge Center. And you can always visit our YouTube channel as well, where you can subscribe and get a whole bunch of important, knowledgeable information that can help you with personal finance and daily. We already have over 1 million views in just under 9 months. Now, I'm the president of Falcon Wealth Planning. We are a fee-only, non-commissioned, true fiduciary, folks, where we help all clients on important topics in personal finance. It doesn't matter what it is or where you are today, how retirement looks like, investments, insurance, estate planning, taxes, folks, you name it, anything that involves a dollar sign, we can help you with. We are giving you 1 to 2 hours, 1 to 2 meetings of our time, folks, at no cost. We can help relate the show to your specific situation. Our phone number is 855-963-2526. That's 855-96-FALCON. Like the bird. Folks, so much to talk about today. I wanted to talk about housing. Housing is, now residential mostly, commercial, we've already talked about commercial, and we said that most analysts think that the price is coming down. And we talked a few episodes away, that could be the case for some areas, like very urban areas, like the Chicagos, the New Yorks, and the San Franciscos and LAs out there. But suburbia seems to be doing just fine in real estate. Here, our headquarters here in Inland Empire is ranked the 3rd lowest vacancy in the country. But that's not what I'm talking about. Most people don't invest into commercial real estate. They invest in residential real estate. Why? It's known to them. They think that, hey, worst case, we can live there if something happens to the house. They can touch it. They can drive by it. They understand the residential real estate agreements versus a commercial real estate agreement. So I get it. And quite frankly, it's roughly the same, what's called cap rate as well. The difference is there's less supply in the commercial world, which makes it at times more of a demand. Now, that's what we're seeing right now. A lot of states, like in Arizona, areas in California, and some others like Texas and so on, is seeing a low supply. This increases the demand, right? There's still people that are moving to the states that we're discussing because of jobs, and they want to buy a house and not rent. They see themselves for a long time. Some people graduate. They have additional people that enter their family, like kids, sometimes parents, and so sometimes newborns. So they want to be able to enhance their experience. Some people get a new job where they're needing a new office, which means an additional bedroom. So there's multiple reasons why people are going to need to move. But now if the supply is not as much, that means when you see a property that pops up, you have to run to it. And it's not just you, it's everybody else in all those different scenarios that I just discussed. So what does this mean? Well, what this means is for you that wants to invest in real estate, is it the best time? Now, most people, historically speaking, all you needed was 20% down, maybe 25% down. On a $200,000 house, you needed $40,000. That's not crazy. A lot of people had equity in their home and was getting a home equity line of credit to get the down payments. Now, I don't agree with that personally. I'm just letting you know that was part of the conversation when they could borrow at 3.25%. Well, now that 3.25% is 8.5%. So my comment to you is it's just not as feasible. It's not as easy to do. So a lot of people out there are sitting in cash saying, I'm waiting for the market to go down so I can buy a bunch. Because when the market crashes, real estate people, banks out there, investors, they don't want to be the mortgage of a declining real estate environment. For example, they bought a house for $500,000 and the mortgage is $400,000, which means 20% down, right? Yes. Well, if the home prices drop 30% in value, that's not good. That means your house is worth $350 and you owe a mortgage of $400. I don't want anything to do with that, which is why most people in 2008, 2009 walked away from their homes. So the idea is that ideally people would like to pay cash for their home. So cash buyers, that's a big deal. So what is the rule for that? Now, historically speaking, and I have a video on YouTube talking about the 4% rule. Well, that seems to be dated because interest rates are no longer 4%. Now interest rates are 6 if you're lucky, in the 6 range, realistically 7%. Has been this high in 20 years. So the 6% rule, what does that mean? That doesn't mean you buy a $500,000 house so you should be happy with $30,000 in rental income. No. Why is it a no? Well, because there's expenses. Let's use LA County, for example, because they're one of the worst in property tax costs. So if you have a home for $500,000 that you buy, assuming that you get $3,000 a month, that's $36,000 a year. That's not what you pocket. You still have to pay property tax. For a $500,000 house, that could be a $6,000 a year property tax. So your $36,000 that you're getting every year in income, we have to minus $6,000 from that, right? Yeah, so you're not netting $36,000, you're only netting $30,000. Well, there's still insurance costs. That could be $2,000. HOA costs, $2,000, let's just say. That's $10,000 of expenses. So if you're bringing in $3,000 a month, well, $1,000 almost is going towards expenses. Long story short, if you're bringing in $36,000, you net $26,000 a year on a $500,000 purchase. That is a 5.2% return on your money. Now, before you're like, yeah, that's great, I'm not getting that in the bank. Well, the question is are you not getting that in the bank? Because you should be getting that in the bank. You got high yields right now, not high yield bonds, but high yield savings accounts. Some of them are FDIC insured, earning 4 to 5%, and you don't have to do a thing. There is no call at midnight about the water overflowing. There is no vacancies. There is no repainting after somebody moves out or recarpeting. You get what I'm saying? There's no late payments. There's no evictions. So I'm not trying to say don't go into real estate. I personally like real estate. I own real estate, residential and commercial. I love it a lot, but I also, if you're talking to somebody who doesn't have not one of his properties has over a 3.5% rate. So now I'm not buying real estate. It just doesn't make sense financially to do so unless you can get a 6% return. So that's a cash on cash 6% return net of all fees. That's what cap rate is. So, for example, if you buy that house for $500,000 and your property tax is $6,000 and you owe another $4,000 between HOA and insurance, you net $26,000. That's a 5.2% return. Well, you need to get $30,000 net a year to be happy with buying a house for $500,000. This assumes you're paying all cash. If your interest rate is higher than 6%, that means your payment's going to be higher because not only do you have interest, but principal as well. You have a negative cash flow. You're really going to buy a property with negative cash flow? You would put $100,000 down for what? To lose money every month? That makes little to no sense at all. So I'll take it a step further, okay? Because this is where it really gets interesting. By the way, folks, hold on. If you're just joining us, you're listening to Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. Today, we're just talking about housing. And really, there's some other issues you have to look at depending on where you're located. For example, if you have property in the state of California, I don't think it's crazy to think with the amount of such small supply, I don't think, I personally think we're going to see rent control statewide, and not just on condos, but residential properties as well, which would hurt residential real estate prices. As an investor, I wouldn't want to invest in that. You get what I'm saying? Something that restricts the amount you can raise rent. And already this state has one of the worst states of the protection for landlords, all the protections for the lessees, for the renters. I'll take it a step further. So yes, we talked about the rent control and so on, but what about with Prop 19 coming out, when mom and dad die, and they had, because of Prop 13, they had a fantastic low rate of property tax. The house could be worth $1 million, but they might only be paying $800 a year. Well, when they pass away unless you move into the house and make it your primary resident, the property tax gets readjusted. So that $1 million house is no longer $800 a year, it's $12,000 a year. Most people are going to sell, which was part of the reason the government did that, is to increase the supply. Well, we have a massive amount of baby boomers right now. And eventually, in 10, 20, 30 years from now, they're going to be passing away at a very fast rate. What do you think that's going to do to the real estate market? A surplus of supply. That might be driving the price down. I mean, you got maybe some affordable housing projects coming up right now. Well, what are you doing there? You're building ghettos? You're only saying maybe certain income people with standards can live in those places? Well, that's not very appropriate. That doesn't seem right. I mean, we can continue down this path more and more, but as interest rates right now are 4.5% to 5+% savings accounts, why would you waste your time to get a rental property now? The answer is you wouldn't. Investors are not investing in real estate right now. Maybe novice people, maybe those who aren't really experienced are wanting to buy residential real estate because that's all they know. Now, that's not very wise, but that's not being diversified. This is where you should talk to a professional, folks. And this is why we're offering a free financial assessment. What I was talking about was just Los Angeles. It's not talking about Orange County or other counties, Riverside, San Fernando. It's not talking about other states. Arizona is very different than Nevada right now, New Mexico, Texas, Florida, New York, Pennsylvania, Connecticut, Illinois, the Midwest, Washington, Oregon. They're all different markets, and they all have different situations. Some states have estate tax, other states do not. Some states are in a bubble right now, other states are in a boom. It all depends. This is why we're offering a free financial assessment, folks. Give us a call. We would love to help. We can help relate this show to your specific situation and see what you should be doing. Our phone number is 855-963-2526. That's 855-96-FALCON. Like the bird, or visit our website at falconwealthplanning.com. That's falconwp.com for short. Folks, we're going to go on a quick break. We'll be right back after a few words. This is Gabriel Shahin, Certified Financial Planner, your host of More Knowledge, More Wealth. That's on every weekend. We're going over all important topics of personal finance. We're going over retirement planning, making sure you're prepared for retirement, Social Security and strategies, real estate, taxes, avoiding them now and in the future, investments, reducing fees, commissions, and so on, insurance, and estate planning. Folks, we are offering a free financial assessment that you could take advantage of. We have offices all across Southern California, including the Inland Empire. Give us a call to take advantage. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, or visit our website, falconwealthplanning.com. That's falconwp.com for short. Enjoy the show. We look forward to serving you. Welcome back, folks. This is Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth. You're on every weekend talking about all important topics of personal finance. Today I was talking about real estate. It seems to always be a big conversation of what you should be doing. My comment is this, and I'm going to kind of flirt with the opinion side of things. And the opinion side of this is real estate you can envision to be very volatile, especially depending on the location that you're in. For example, Nevada is having some tough times in certain areas right now where they've seen a reduction of some areas over 10 to 20%. There's certain areas in Arizona, in California, that's been the same way. Arizona has been a very stable market. Still, there was a mild decline, but now we're seeing that increase right now. You're seeing multiple areas, whether it's in Texas, Tennessee, Ohio as well, where there was affordable housing there. You've seen some slowdown in certain areas and some pickups in others as well. So the recommendation I made earlier, if you're an investor, is to look for that 6% rule. But historically speaking, in states like Ohio and Tennessee, you want to look for a 10% return. Because historically speaking, the property taxes are too high and values tend to stay low. And that's why Texas historically doesn't appreciate well and has good yields on residential real estate, where historically the price doesn't go up because the price of property tax is just too high. It's like 3% in some areas. California is 1.2. Let me give you an example. $500,000 would be $6,000 in LA County for property tax. In Texas, $500,000 home could very easily be $15,000. It can be expensive. And that's like kind of normal. It can be higher than that as well. There's multiple different property taxes over there from an assessment point of view. So the idea of investing in real estate right now could be worrisome, because also continuing that conversation is, yes, there are also issues with people doing 1031 exchanges. These are investors that sell and want to go into another project. Well, let's say they started that project and it was 3.5%. And now they need to do a 1031. Let's just say they owed $500,000 on the, the property's worth $500,000, but they had a $300,000 loan on it. Well, now they got a 1031 into another property. They only have $200,000, folks. They only have $200,000 of equity. We're not even talking about what they bought it for. So $200,000 of equity. Well, they only have $200,000 to still buy a home of equal or more value to complete the 1031 exchange, which means they have to still get a loan of $300,000. Well, the new loan of $300,000, the rate isn't 3% anymore, it's 7%. It doesn't make it as economically feasible. This could cause issues, yet again, for real estate prices. The investors are no longer in the business, especially if they're looking to do a 1031 exchange. We had a previous episode talking about commercial property, how something crazy, 40% of all debt is going to be coming due in the next 2 years. That's kind of alarming. What do you think the trickle effect has on residential when that happens? You have ARMs. People are investing in ARM loans. There was an episode I did maybe a few months ago that said, maybe it makes sense for you to get an ARM loan. What is an ARM? Well, you could do a 5-1 ARM, which means the rate is normally lower than a 30-year mortgage. So instead of maybe paying 7%, maybe they'll do it at 6.5%. But in 5 years, that loan matures and becomes variable. So it's still a principal and interest payment over 30 years, but then at year 5, month 61, it gets reassessed at whatever the rate is at that time. Well, the idea and logic is, number one, you might not be living there, and number two, what if interest rates drop within that 5-year period? You can always refinance and lock in a 30-year at that point. You saved 0.5%. Saving 0.5% on $500,000 is $2,500 a year that you're saving. Now, it's a little different because the amortization schedule pays off principal, but you get what I'm saying. My point is there still could be some issues behind that affects real estate prices. I still think that with the generation, yet again, now going to my personal opinion, is there is a new generation of people that love living as a nomad. And COVID enhanced that. Why? Because they were able to go to Hawaii and live there and work for a year, sometimes 2 years, or anywhere else. They love that flexibility. They don't want the burden, by the way, the liability of owning real estate. I'm not agreeing with it, by the way. I'm just telling you, which means the demand, there's already way more baby boomers than there are of Gen X and Gen Ys. So they're going to be selling, and quite frankly, might be going into a retirement community. Quite frankly, they might hold on to it, but their heirs can't afford it because of the reassessment of property tax in states like California. And they're looking to sell it because the kids don't want it, which, oh, by the way, now you have a supply issue. Maybe real estate, maybe we're seeing these long-term cyclical places where real estate does poor for long periods of time. That is a very reasonable outcome. I'm not saying, this is my opinion. Everything is supply and demand. We know that from Economics 101 that we learned at 19 for those who were business majors. What I'm talking about increases supply. And by the way, these homes are getting older. By the way, this was before a lot of these regulations. You're gonna have to buy a house for market value just so you can go in there and renovate the whole thing. That becomes expensive. Does that make sense? Does the future of these new developments? Well, states like Arizona, California, Nevada, they grow outward. It's not like New York and San Francisco where they grow up. That's why public metro systems work really well in certain areas in the East Coast. Not in states like the Southwest or West. They do not have the best public systems. San Francisco is maybe okay because that specifically is very dense. But the idea and the assumption that real estate only goes up, you have to kind of check yourself. And real estate is not considered liquid. I mean, you could define liquidity as something you can get your money in 14 days. You can't always get that in real estate, and if you do, you don't know the price you're going to get. This is why some investors like real estate investment trusts. They call them REITs. Not the REITs that are sold to you at free dinner seminars where you're paying 10 plus commissions, 10% plus commissions. I'm talking about the ones that are publicly traded where you can sell in and out of every time and there's professional management doing it for you. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, Certified Financial Planner, and your host to More Knowledge, More Wealth here on every weekend talking about all important topics of personal finance. And there are some REITs out here, which I was just discussing, that are residential REITs, that are commercial REITs, that yield 6%, right? Because that's what the rental income is getting. And to define itself as a REIT, the best part about it is they have to kick out 95% of what they collect and hold on to 5% reserve for themselves. My point is, this can make a lot of sense for you. And by the way, a property manager charges 10%, right? Right? Your rental property of $3,000 a month, they're going to take $300. You're going to think you're going to negotiate at $5? Good luck with the quality of that. But even if you do, maybe it's a friend or family, whatever the case is, you're still paying $150 a month. My point to you is that there are other alternatives out there. I'm not trying to say buy REITs. You got to know what you're buying into. Some of them are illiquid, by the way. Some of them have very bad debt, very bad portfolio, very bad papers. So I know a lot of people like private debt. I mean, we use private debt here at our client, at our firm at Falcon Wealth Planning for some of our clients, but that might not make sense for everybody. Each situation is different. The question you have to ask yourself is, what are you trying to achieve? Are you trying to play the game of Monopoly where you just literally own real estate? Or are you trying to supplement income? You're trying to simplify life. You're trying to be comfortable going on a trip for 2 to 3 weeks or even 2 to 3 months without having to worry about what's happening in your specific demographic of real estate with supply and demand and law changes. Like when Prop 13 now have molded to something that's Prop 19 in the states like California. These are why I mentioned it's important to understand your situation, what you're trying to achieve. And folks, that's why we're offering a free financial assessment to take a look at your situation where we'll give you 1 to 2 meetings, 1 to 2 hours of our time, folks, at no cost. And it doesn't matter where you are. We have offices all across. I've been talking about Southern California because that's where I live. That's where our headquarters are, but we have offices all over, folks. We help people nationwide. Folks, give us a call. We would love to help. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, or visit our website at falconwealthplanning.com. That's Falcon, WP.com for short, where we can help put an assessment together really to make sure we can relate this show to your specific situation. Because this may be the time while there's low supply to do something with your real estate. Because a lot of people right now, even if they're looking to upgrade and they can afford to upgrade and pay that premium of no supply, they're holding onto their real estate properties. Why? Because they're getting a low rate. But what sometimes they have to reanalyze is if you sell that home, you get $250,000 tax-free exclusion based on what you paid for and net of costs. And if you're married, that's $500,000. You get to do that tax-free. I would rather have you sell your home and buy your neighbor's home. You get what I'm saying? So you have to understand your situation and the type of home that you have in the location. If it's $1 million home, are you happy with $4,000 a month? Who cares if your mortgage payment is $1,500? No, it has to make sense financially. You're netting $2,500 on maybe $800,000 of equity. Okay, that's $30,000 a year. Okay, like, is that a good cash-on-cash return for you? Especially if you ever decide to pay it later, you're going to have to pay a ridiculous amount of capital gains. Depending on your situation, these are the reasons you have to get these analyzed. And yet again, this is why we're offering a free financial assessment. Folks, give us a call. We'd love to help. It's not as simple as it seems. Falcon Wealth Planning's goal and agenda is for planning to be made simple. That's why we trademark Planning Made Simple. My comment to you is talk to a professional that does this every day. Not doing it as an amateur. It could cost you thousands, tens of thousands, hundreds of thousands, and in certain situations, millions of dollars. Typically, the people that it would cost them millions of dollars have advisors already. But my point to you is, let's not just have the rich continue to get rich. We're offering a free financial assessment that can help you, and we don't charge an arm and a leg if you decided to retain us. Folks, that was a fast show. I want to thank you for tuning in with me. You can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 96 Falcon, like the bird. Or you can visit our website at falconwealthplanning.com. That's Falcon, WP.com for short, where you can get this episode or any one of our previous episodes as well. And feel free to join our podcast and our Spotify for the podcast of this. And we have our Knowledge Center on our website where you can go click on our YouTube channel and get a bunch of information, as we've had over 1 million people have views to our content in just under a year. Folks, this was a fast show. We want to thank you. We want you to enjoy your weekend. We want you to have a great week, and God bless.